Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, memory chip prices strike again, this time taking a toll on Cisco, even as AI demand surges. We'll break it down.
Plus, Apple's revamp of its Siri voice assistant hits new snags that could delay the release of some features.
And Altruist launched an AI tax planning tool, and within hours, wealth management stocks tumbled. The CEO of Altruist joins us to discuss.
But first, we check in on these markets that in many ways are still digesting AI disruption. We focus in on Cisco, that I know you'll go to. We're off by 1% on the Nasdaq 100. That anxiety of costs, of memory costs, really building into the benchmark. But more broadly, we're all eyes on costs for consumers. CPI print coming later in the market, just a little bit nervous ahead of that. Bitcoin down another day, off by a percentage point. 67,000 is where we trade for this particular risk asset. Ed, what are you looking at?
There's a lot of pieces of consecutive red on the screens we've been putting up. Cisco, no exception. Down 11%, on track for its biggest drop since May of 2022. And prior to today's session, it was up 11% and had momentum. Outlook is strong on sales for the current period. AI demand's there, but there's margin compression. Memory chip prices. Let's get more with Bloomberg Intelligence senior hardware and network analyst Woo Jin Ho. It's actually probably a good time to remind us what Cisco is and what Cisco does. But the memory issue is factoring in to servers. And right now you are leading with your React piece on the Bloomberg terminal with the memory chip issue. What do we need to know?
Yeah, hey, Ed. So really quickly, what Cisco is the leading global provider of networking equipment for corporate as well as for data centers. And they've actually had a foray into cloud data centers to help power some of the AI workloads. Now, what happened last quarter, they got the AI orders, momentum and drove a lot of the upside on sales. But the gross margin issue, especially given from the DRAM pricing, is a lot bigger than we had thought.
Chuck Robbins, though, was trying to say that, if anyone's going to navigate this, they're going to navigate it. They're already going to their suppliers. They're already thinking about increasing prices. How well can they handle it?
Yeah, so we did the math for the third quarter. There's about 200 basis point product erosion on gross margin. But when we look at the fourth quarter, they're able to stabilize that. Now, if we think about 2027, they actually have a fairly sizable software business. And if software really starts ramping up, we could start seeing some gross margin stability in 2027.
Woo Jin Ho, Bloomberg Intelligence. There we have your piece, Cisco's results outlook pinched by memory price spike. Look, all of this is as Cisco's numbers. They highlight the heavy infrastructure build out, but have investors really questioning what happens next for the implications for software too. Joining us now to go across the whole gamut is Tony Wong, portfolio manager at T. Rowe Price Science and Technology Fund. In his latest thoughts, he says that recent software sell-off is more of a valuation reset and that companies that successfully embed AI into workflows could drive stronger productivity and margins over time. And Tony, what's so great about having your voice on this show is you time and time again have been like the proof point, the ROI is going to be productivity gains. Suddenly we got the productivity gains sort of shining a light that we're actually worried it's going to really hit valuations. How do you weigh where we are in terms of the sell-off and if it's overdone?
Yeah, well, I think it's the key question the market is wrestling with right now. And so when I think about it, it's really just what is on the right side of change, I think, and what is the inevitability here. And I think what you're seeing with Claude Cowork is that these agents are becoming more autonomous and they can actually execute things on their own, do more than just like you have to prompt something like ChatGPT, for your own personal ChatGPT. But so it's exciting is that these enterprise agents, I think, are going to be more of a force here, and we're starting to see that really pay off. And when we think about it, I think why the market's reacting the way it is because if you think about it in the future, there are wide sweeping implications for what modes mean, in terms of software as well as information services. So it's definitely a disruptive potential force here.
Disruptive to some of those in your portfolio. I'm looking, you are exposed to Salesforce, you are exposed to Accenture, which people have been worrying about the consultant side of the equation. Even Shopify, even though it delivered strong numbers, got beaten up yesterday. How are you being discerning at this moment of where you actually buy into on a dip? Because you do think that they'll manage to ride this software disruption.
Yeah, so I think that it's more important that you're the platform and not just a feature. Because if you're a feature, then the AI agents can code software so easily and costlessly that you essentially can be embedded in a bigger platform. And so I think that increasingly you want to make sure that you're the layer that all these agents need to coalesce around. And I think that there's going to be a lot of change here in terms of, and we honestly don't know. And so I think the market is in a sell first and ask questions later mode. And so it's important to kind of stay on the right side and manage these changes in the market.
Tony, NVIDIA CEO Jensen Huang has this line that software is now worth paying for. The example he would give is Cursor. But I guess what we're trying to do with you is define what software is that is worth paying for. You just brought up Salesforce, right? So in the most recent quarter, they had like more than $1 billion of ARR directly from AI. And they talk about all the almost 19,000 agent force deals that they have. Yet they're still subject to this same AI is going to eat software's lunch chat that's going on right now. Why do people not believe the traction that they have, as an example, that it's worth paying for?
Yeah, so I think there's two things that I think about. One is that there's just so much competition when you think about all these AI native startups, and they're pricing in a way that is really compelling and to drive adoption, essentially. So you think about like image generation, right? Like you pay $20 a ChatGPT, you can generate unlimited images, whereas on Adobe or Firefly, you have to pay per image generation. You can think about, Claude Cowork, similar way in terms of what they're pricing versus the value that they're delivering is really compelling. And so I think one, you just have a lot of price deflation, and that's why I think a lot of these software companies are looking to drive adoption. Their economics aren't as good as the seat-based model. And we're going from like a seat-based model to outcomes and agents, which is a very different version.
Just for reference to our audience, NASDAQ 100 near session lows, now down 1.25%. This story started in Europe in August. I was there in London. I remember the day all the European software stocks sold off. Earlier today, we spoke to the Siemens CEO. Let's get his take.
We know that AI has the potential to disrupt some of the software businesses. I mean, if you talk about software which runs on call centers and the like, I mean, that's fully on the block. But if you go on the other end, on industrial software, simulation software, physics-based software, we don't see that at all. We rather see an enrichment of the software, which allows more and more customers to use it.
Another software CEO whose fate is very closely tied to a relationship with NVIDIA, and I think it's important to point that out. But his argument is that actually specialized software is getting better because of AI. You buy that?
I think so. And I think that I think a lot of the economics will be made at the specialization of the niches. So, domain-specific knowledge will always be very important. And so, I think just general knowledge is probably going to be not take the economics. And so what really matters is like being able to like put this into ROI. Now, at the same time, it doesn't mean that if you have a stronger model, that doesn't mean it doesn't create more competition for existing incumbents. So I don't think the battle is won or lost for these companies. And I think it's just important that they stay front-footed in incorporating the latest technology trends into their platform.
And your science and technology fund has all the trends. You're in hardware, you're in software. Your number one holding is Alphabet at the moment, then NVIDIA. But going back full circle to Cisco, your exposure there, what do you think about the memory price implications and how you can weather who are the winners and losers in that situation? How long for?
Yeah, so I think that, memory, it's a fascinating industry because one is secular trends and AI is not just new TAM. And then we've also gone through multiple years of underinvestment because memory's been a downturn. So I think one, it is that there's secular, but there's also cyclical elements of it. So, in terms of our portfolio, we definitely own a lot of the bottlenecks where the economic value capture is in, such as memory. At the same time, I think that Cisco networking and is also going to be participating in AI. I think that the implications of the memory shortage is actually becoming more widespread and having implications that a lot of times the market didn't think about. So, it is fascinating, but I do think Cisco continues to be a really important company that's driving a lot of this AI adoption.
Tony Wong, T. Rowe Price, great to have you back on Bloomberg Tech. Really appreciate it. Now, coming up, Apple's new Siri runs into more snags during testing. What's delaying the AI upgrade? We have the Bloomberg reporting next. This is Bloomberg Tech. Apple's revamp of its Siri voice assistant has hit new challenges that could delay the release of some features, according to sources. Bloomberg's Mark Gurman, as always, has the details. Let's get into the details. What do we need to know? What's new? What are you hearing from inside the company about the latest snag with artificial intelligence-powered Siri?
So Apple has been planning to launch the new Siri. This is an AI revamp it initially introduced in June 2024 at its developers conference, allowing you to tap into features like your personal data to fulfill queries, on-screen content, and precise control of apps. It was supposed to launch next month in March as part of an update called iOS 26.4. This had been the plan for several months. It's actually been the plan for well over a year at this point. Now that is being delayed and staggered potentially. Right now, the delay is moving many of the Siri capabilities to iOS 26.5. That's scheduled for sometime in May, June, so about a couple-month delay. But some of the features, including the personal context features, those are likely not to launch until September as part of iOS 27. So a bit of a delay there. And, altogether, it's possible that these new features are not going to launch until 2 years after they were initially introduced. The setback for Apple here is not necessarily in phone sales. People are still buying iPhones. You saw the $85 billion worth of sales, which could have even been more if not for some manufacturing challenges. But the challenge is, where is OpenAI? Where's Anthropic? Where are Google going to be at the end of this year, right? They're likely to be well ahead of where they are today. So that's really what we have to pay attention to.
Let's talk, Mark, about how, therefore, the Google integration is going, because in many ways this just fits into the overall Apple intelligence stop-start and how they're going to be building out from within.
My belief is the only reason they're going to be able to get this done this year, which I still believe they're going to do despite these latest snags during testing, is because their models are being improved by the Google Gemini team as part of that collaboration between the research labs at both Apple and Google. So that is going to be a major boon for them. I do expect this big Siri chatbot revamp in iOS 27 coming out with the iPhones in the fall to be pretty nifty and pretty cool, a new way to control your phone with AI. They just need to pull it off, and I think they will. But the big question is, how impressive is it going to be in September compared to whatever OpenAI and Gemini has for their own customers and Anthropic has with Claude in 6 months from now?
Bloomberg's Mark Gurman, we appreciate you on all things latest with Apple. Meanwhile, let's turn our attention to social media now, because Instagram boss Adam Mosseri testified in a landmark case that likened social media to digital casinos. Mosseri told the jury he doesn't consider problematic use of platforms like Meta to be the same as, quote, critical addiction. Bloomberg's legal reporter, Madeleine Meckelberg, is with us. You were there in the hearing in LA. And so the push on Adam Mosseri, anything different that we've heard on other occasions that he's testified?
So he covered a lot of similar ground to things that we've heard before in congressional testimony and other public remarks about this issue of social media addiction. Obviously, what's unique here is the context in which he was giving this testimony, which is this landmark case that's testing whether juries will respond to claims that these companies knowingly designed their platforms to addict young users. but we heard him cover a lot of different ground. As you noted, he talked about this issue of clinical addiction versus problematic use, which is something that we hear a lot from social media companies referring to people who use the platforms more than maybe they feel good about. We also heard him talk about some internal emails in the company when he was asked about them by the lawyer about decisions they were weighing about certain features on the platform related to photo filters on Instagram.
Madeline, this is a process, right? Both sides present arguments. You have plaintiffs. What do we need to know about what happens next? Who else might testify? And what is under consideration at the heart of the trial?
That's right. So we're in week one of what's expected to be an 8-week trial. Adam Mosseri was the first executive to be called to the stand, but he will certainly not be the last. As you said, this is the plaintiff's case. They kind of get the first chunk of time at the trial, and then the defendants, in this case, Meta and Google, they're going to get a chance to respond. We're also expecting to hear from Mark Zuckerberg of Meta. We're expecting to hear from YouTube CEO Neil Mohan at some point. And we kind of got a little bit of a preview that we're going to be hearing from executives a little bit further down the food chain who maybe were weighing in on some of these decisions. But the heart of this case is about this question of addiction and whether or not these platforms knowingly designed these tools to hook young users, resulting in mental health struggles. This case, of course, centers on one individual, a young woman from California, and her specific allegations, but it represents thousands of other cases that have been filed. So there's a lot of attention on the outcome here because it's going to dictate how the rest of these cases are decided.
Bloomberg's Madeline Meckerberg, thank you very much. Now, coming up, Altruist introduces a new AI way to plan your taxes. We speak with Jason Wenk, Altruist CEO, next. This is Bloomberg Tech.
AI. It's at it again, and it's been a wonky, worrying few days for wealth managers and those who've had shares in it, considering the technology's impact. It's all started Tuesday. A startup called Altruist added a tax planning tool to its AI model, Hazel. Within hours, wealth management stocks had tumbled. Charles Schwab, LPL, Raymond James, as you see, down significantly. And that's as investors really feared AI disruption. The CEO of the company that kicked all of this off, Altruist's Jason Wenk. Jason, did this take you by surprise?
Yeah, I think, to be incredibly honest, I don't think anybody could have possibly thought that, somewhere between, tens of billions and maybe 100 billion of market cap would be wiped out in a week. AI is very powerful, and certainly the market, reaction tells me that there's, a lot of people voting with their dollars and the potential disruption.
Jason, all of this is about enabling wealth managers, individual wealth managers from your part. Just remind us what Altruist does and what this new development in terms of building in a tax tool does to help them.
Yeah, absolutely. So I think you hit the nail on the head. Like, the most important thing is that we're not trying to displace financial advisors or wealth managers. It's not AI taking those jobs away. It's AI to help empower them to do better work for their clients. And in many ways, when people think about wealth management, there's deservedly a lot of critique. It could be things like, why is it so hard to get access? Like, the minimums are really high. Why are the costs very high? Why are the results sometimes inconsistent? And a lot of that is, because of how much manual process and human labor is involved. You just have a lot of limiting factors. AI very much is a incredible equalizer. Effectively with a tool like Hazel, what used to take teams that were 10 or more people working hundreds of hours and costing many tens of thousands of dollars, it can be done in like 2 to 3 minutes. Users, the advisor users in our case, are paying $100-ish per month, right? So much more affordable, much more accessible. And tax is just the start. We launched Tax First for what it's worth because it's tax season in the US. We wanted that to be our first agent, to kind of get out there in the hands of wealth managers and advisors. But this is a pretty good harbinger of the things that will come. There'll be more agents doing more work that will continue to make advice better, more affordable, and more accessible.
Jason, you will have noticed that some of the CEOs of those wealth managers appeared on television in the days that followed the sell-off. Here's Charles Schwab. Listen to what they had to say.
AI is a real accelerant. So it was puzzling to see our stock sell off related to AI because we're benefiting from it in multiple ways and bringing it to our clients. It's allowing us to reach new clients. And I think that's why you won't see the population of advisors shrink is that AI will be useful in reaching new clients that we couldn't before.
Has Mr. Worster or any other leader in that field phoned you since Tuesday? And would you be open to working with these companies literally jointly?
Yeah, so no, I haven't heard directly from Mr. Worster, but we already actually work with any independent financial advisor. One of the reasons why we stood up Hazel as a separate entity, Altruist, of course, is a direct competitor to Schwab, Fidelity, LPL, and others. But we wanted Hazel to be something that any advisor could use to help any client. And we didn't want them to be forced into using a single custodian. So there are already thousands of advisors who use Schwab, for example, as a custodian that are leveraging Hazel and doing so to drive better outcomes for their clients and a lot more operational efficiency for themselves. And we have, I'd say, in the last 48 hours, it's in the hundreds of very large, significant, wealth management companies around the world reaching out to see if there's a way that we can partner. So definitely looking forward to, putting this tool in as many hands of as many capable advisors in the U.S. as possible.
Let's talk about the tool and the technology. What are the data sets that the underlying model is trained on? What is your core competence that, if there is concern from the legacy industry of wealth management, what is it they should be concerned about? And what is it that makes this model powerful?
Well, so again, there's two parts to that. I'll try to be succinct. But the first is, I think what causes concern is not so much just the AI. It's the fact that we also have built a very modern infrastructure for our wealth business. So the things you can do on Altruist, you just can't do anywhere else in terms of the speed of opening accounts and funding accounts and managing of assets. If you take AI and you put it on top of bad, antiquated infrastructure, you're not going to get a ton of value. It's kind of akin to putting like a self-driving on a horse and buggy or something like that. Like you need to have like an entire vertically integrated ecosystem. I think if anything, that's maybe where some of the market concern is that what happens if something like is digital and it's 20 or 30% better. You add AI and multiple agents, it becomes 200 or 300% better. Now, advisors could very much have a shift in where they decide to custody their assets. That could be pretty monumentally difficult to overcome for some of the big incumbents. As far as what makes the model unique, the way that we built Hazel's, we rely, like most AI companies, on having really clean data. So data is a huge advantage. I think Mr. Worster was right in saying that data is very critical. In the case of a custodian, you have the ultimate system of record, meaning we have all of this data on clients, transactions. That makes it a lot easier to give personalized analysis and feedback back to the users.
Jason Wenk of Altruist. Sorry, we're out of time, but grateful for the conversation. Coming up, we look at Waymo. We'll be right back. This is Bloomberg Tech.
Welcome back to Bloomberg Tech. A lot of action in the markets today. Let's just go through it in terms of the NASDAQ benchmark, currently off by 1.8%. We're at session lows. This is as we worry about earnings and how they're implicated by prices. Prices of memory, Cisco in particular, down significantly. I wanted to shine a light off by 11%. So we've got that anxiety about whether AI is really helping these businesses or whether pricing pressure is hurting them. Remember, the macro picture is about to get CPI data, so pricing pressure for the consumer too. As we build up to that, the market's just a little bit jittery. Adyen, over in European trading, check it out, by 20%. This is the payments company, fintech, which is being hit by consumer sentiment being on the downside. Also, a weaker dollar hit them as well in terms of payments revenue, and their earnings outline just really not living up to expectations. We move on and have a think about what's happening when you've got exposure to the private sector. Now, many are saying, I'm talking BTIG in particular, saying that SoftBank is like the way to play OpenAI exposure as well, because they've already put $36 billion in. They're looking to increase that maybe up to the tune of $30 billion. They have an 11% stake in the business, and actually they managed to post a profit, the fourth quarterly profit in a row, not seen since 2021, as their investment stake in OpenAI goes up and to the right, helping offset some other losses. But the stock traded in the US, if you're looking at depository receipts, currently off by 3%. So we'll dig into that a little bit more, Ed. But it's interesting what's happening in terms of the SoftBank story.
It's a little bit like shuffling the deck, and like, you know, you have to sell at certain holdings to fund investment deeper into the names that you're most interested in. Like, it's not rocket science at the end of the day, Caro. One quick question to ask is like how wide SoftBank is exposed beyond one single name like OpenAI, given how ferocious the lab battle is right now. Yeah, OpenAI they're in on. Remember, they've been going into chip design companies like Ampere. They've been looking real exposure to ARM, but they've been cutting back on their T-Mobile exposure to be able to get more into these privately held businesses. Yeah, they've also been buying private equity companies, right? Because they want the exposure to data center. Yeah, I'm glad the team got that up. I mean, you know, far right column says everything. Let's get to another story in the private markets that we've been trying to update you on regularly. Anthropic is close to locking in a deal to raise more than $20 billion in a funding round co-led by investors, including Peter Thiel's Founders Fund, D.E. Shaw, and Dragoneer. That's according to Bloomberg sources. One of the largest startup funding rounds ever. And who's been across it? Bloomberg's VC reporter, Natasha Mascarenhas. Important detail. Actually, like, some of those names are interesting. You know, Dragoneer's come up a lot recently. Waymo was something we reported a couple of weeks ago. Right. What do we need to know? Like, how close is this, and who's leading?
Yeah, listen, on Monday we were discussing where are the crossover funds in this round. Now we have some examples with D.E. Shaw, with Dragoneer. We also have a continuing list of traditional venture capitalists in the round. What I'm really paying attention to is the addition of Founders Fund to the cap table. Right. That's an early OpenAI investor, and Founders Fund is known for concentrated bets. So it is interesting to see an early OpenAI investor go ahead and be a major investor in this Anthropic round, and Founders Fund is not alone. We're seeing Sequoia as well in the round, and the list grows.
It's interesting. I know another VC that makes concentrated bets and doesn't go in to other companies that seem to directly compete. So how much of a taboo is it that VCs back two horses, almost like having some sort of option here?
Yeah, I mean, it used to be a huge taboo because of concerns about information leakage, or how do you really take that out of your head when you're in a partner meeting and discussing, you know, two different roadmaps that are, you know, both in this case going towards a version of AGI. What I would say, and what we are reporting, is that certain investors get certain information rights. In the case of OpenAI, sources are telling us that if you have a certain amount of ownership in the company, that comes with its own information. And so what we're really wondering is who's taking big checks in these rounds, because they are the ones that will have to answer the questions of how are we keeping the information separate.
Bloomberg's Natasha Mascarenhas, thank you very much. Now, Waymo is aiming to have a big year, adding new US and international markets. The robotaxi firm also recently raised $16 billion from parent Alphabet and other outside investors. Co-CEO Takidra Marikana sat down with us and discussed the company's plans, including whether it's considering an IPO. Listen to this.
We are just laser focused on execution. Building Waymo to be financially responsible, operationally excellent, and then make sure we maintain the safety culture. Like, that's what we're really focused on. Having this vote of confidence, as you said, not only from Alphabet, but from our three co-leads from this round, and from all of the new investors who decided to join our cap table, and the existing ones who doubled down on their belief that this is the right opportunity to fund. And so we just feel humbled. But also, there's a lot to do. So we're just really focused on making sure that we can scale, focusing on our two first international launches, right, London and Tokyo, and scaling across the United States.
We do not yet have, although there has been progress toward just this week, a federal level framework, set of rules. What do you think the direction of travel is with that? And clearly, if you had to deal with one set of rules and not a city by city, let alone state by state basis or case, you'd be making a bit more progress, I suppose.
Yeah, we think it's really important that there is a federal AV standard. We've been advocating for sort of a safety case-based approach, right, because the technologies are different. And we think that the burden should be on companies to demonstrate why you believe your technology is safe enough. We also think there should be transparency requirements. People should have to demonstrate how many trips are you providing. Right now, the balance isn't quite there. I mean, some states require a lot of reporting. Some don't require as much reporting. I think the United States has an opportunity with this technology to lead globally. And I don't think you can lead globally if it's a framework that's governed by multiple jurisdictions across the states. And it's a way to slow down the adoption of this technology, not only in the U.S., but in other markets.
New York City, not necessarily New York State. A lot of people want to know what's the roadblock there, pardon the expression, and what's the timeline. You work closely with the authorities, but that is a big potential market.
Yeah, that's a market where, we're just going to have to do the work and demonstrate our safety outcomes and earn the trust and chisel away at it over time.
Do they have the rules for you to follow?
They do not have rules that allow the human operator to be removed from the vehicle entirely.
And until that changes?
But, there is an interest in doing this in the state, even outside of the city. And that gives us an opportunity to grow more fans. And fans actually are calling for this in cities where our technology can't be deployed. We are seeing organic campaigns spring up saying, I want Waymo in my town.
San Francisco, the Bay Area, is my home. London's where I grew up. And I was studying the map of the boroughs that you proposed to launch in. And you correct me if my math is wrong, but just based on those boroughs, at launch, this seems to be the biggest citywide deployment from the start that you guys will have done. Is that correct?
It's correct. I mean, we're in the phases of figuring out the specifics around the launch and figuring out the actual framework around the launch. And so I don't want to speak too definitively about what we're going to do. But what you're speaking to is we're not gated by the technology.
Right.
And we have the appetite to scale. And we want to partner and do so safely. And we want to earn trust. So that's there's a lot of levers there that we have to figure out how to strike the right balance and how to make sure that we're introducing it to the community, both to meet the demand and to grow the
I asked because of those 20 cities to come, London is one.
Yes.
And London is now outside of the European Union, but it's kind of your Europe launch.
Yes.
What was that experience like within London's regulatory framework and the UK's regulatory framework?
They've been extremely forward-leaning and interested in seeing how this technology could actually improve safety on their roadways.
Right.
And that's where I think, we find a sweet spot when people are less sort of complacent about the status quo.
Waymo co-CEO Kedra Mawakana. Ed, I mean, we've got to check out the full interview. It's on Bloomberg.com, or as a special edition of Bloomberg Tech Podcast. But really, your conversation is about this extraordinary expansion into London and just what pace of growth, what signals are you discerning as to how big it could be there?
No, you and I have both called London home, right? And we've taken the bus and the tube and gone on bikes. And so how do they get past what's a really established transit network? And right now, there are several dozen Waymo vehicles testing in London. They are doing that in more than 30 of the 60 London boroughs. 60% of the city's already covered. That's way beyond what, for example, Tesla's doing in Austin, right? Even the Bay Area here in terms of their scale and footprint. So there's a big expectation that if this Labour government is doing okay and passes the rules, then they can do this for real this year. No safety driver or supervisor, and have a commercial service at scale that they haven't done that quickly in the United States.
Look, this is about disruption of transport. And it looks as though transport and logistics is in the eye of the storm in terms of disruption today as well, if you're looking at the markets. Now, you and I have just been poring over some of these market moves. Extraordinary for C.H. Robinson, down by 21%. But you're actually seeing the Dow Transports, the index having its worst day since April of 2025. Currently down by 5%. Now, traders are telling Bloomberg, Kuehne + Nagel, for example, which is another European logistics company, traders are citing an announcement coming from Algorithm. Now, Algorithm is a US-traded company, and they've announced that, as a leading AI technology company, they've published a new white paper demonstrating its semi-cab platform reduces empty freight miles by more than 70% across active customer networks. Is this the next AI shoe to drop, Ed?
It was a severe, sharp drop, and we got to keep looking into it. Coming up in the program, back to AI, Similey secures $100 million in new funding as it looks to scale predictive AI that mimics human behavior. We have more on that next. This is Bloomberg Tech. AI startup Similey has raised $100 million in a new funding round led by Index Ventures. Similey is an AI lab that wants to help companies predict human behavior. In fact, a chain of human behaviors. For more, June Park, Similey's CEO and one of the founding group, is with us in San Francisco. This is very interesting because the field has tried to develop a model that is a behavior model. And it has had mixed success, some failure. Let's start by talking about the data sets that the model is trained on. How did you develop what you think is a model that does give you an insight or a prediction of how a human might behave?
Absolutely. Thank you for having me. Glad to be here. So Similey is a company that is spinning out of Stanford, where we led frontier research on creating agents and simulations that leverages generative AI technology. So today, we partner with millions of real people and combine our data collection strategy with our modeling strategy to create agents that can actually behave in a much more generalizable context. So data here we might leverage include interview data that's unstructured, which is the kind of data in the past was very hard to leverage.
Literally people telling you their life stories.
That's exactly right. So we actually create AI interviewer that can go talk to people one-on-one, voice to voice, and actually get life stories and their preferences around different policies and so forth with their consent.
And to what end? I mean, to build simulations that are 100% accurate, to then populate this with agents, June, how do you see this work that you've done proving more disruption to the market right now?
Right. So today we work at Fortune 10 companies in retailer businesses, to personal finance, to CPG companies, and even to polling companies. And today our customers use our technology to do concept testing. So for instance, CVS has been a close partner for the past 5 months, where CVS has now created hundreds of thousands of similes, or quote-unquote agents, that represent their real customers. So they can actually do simulated focus groups to better understand their pain points and their use cases, but also to do store layout designs and so forth. Gallup, another polling company that's highly well established and respected, is now working with Similey to create digital panel of their agents or their simulated human panels. Now, one last example that's interesting is, of course, many of our customers are Fortune 500 companies that regularly have earnings call. So use case there might actually be creating simulation of the earnings call. So this is an ask that we get frequently. So in the recent earnings call we simulated, we actually can predict 8 out of 10 questions that are actually asked in these calls.
Sorry, June, you're saying the analysts almost don't need to be asking their questions. You can predict with 80% certainty what analysts are going to ask CEOs, CFOs on earnings calls.
That's exactly right. In fact, I actually, before our conversation today, I had a chance to simulate the questions that two of you might ask. And these are some of the questions that actually have come up in our simulation.
Oh, so you do seem well prepared. Look, there's a degree of skepticism about Similey, to be fair. The founding members, 4 of you, are largely academics at Stanford. You founded the company officially a year ago, but you've only been training the model for 7 months. You say you have 5 months of commercial deals. How have you done that so quickly?
So Similey is a real combination of amazing frontier researchers that raises the ceiling of what the models are capable of today, but also amazing product and engineers. So here on the product side, we have people like Lainey Allen and Mika Kapoor, who have been product and engineering leader in the space of companies such as Figma and Hebbia. And that, combined with the rest of the engineering team and the research talent, enables us to create frontier technology that actually gets routed directly to product.
June Park, who has preempted all of our questions through his own product of Similey, we so appreciate your time. Thank you very much indeed. Let's just take a look elsewhere in AI model world, because Alphabet currently spiking higher up almost a percentage point. This is as they've updated a release to Gemini 3. Gemini 3 deep thinking reasoning model. It's an update, and they say that the mode has been updated to solve modern science research challenges in particular, Ed. Look, Alphabet has been on a tear because of the idea that its generative AI is managing to leapfrog or at least push ahead some of the rivals.
Yep, it has. And look at the spike in the session on those headlines. So coming up, Coinbase releases earnings after the closing bell. We're going to preview what to expect. This is Bloomberg Tech. Asian delivery firm Grab missed analyst expectations on its full-year forecast, a sign that weaker consumer sentiment is weighing on the company. Earlier, we spoke with Grab CFO Peter Oey. Listen to this.
It was an amazing year for us. We achieved some new milestones in the business. We have now 50 million monthly transacting users using our app constantly on a monthly basis. We also showed great profitability in the business, to over $500 million in adjusted EBITDA, but also our first year net profit in the business. As we look at 2026, we're firing on all cylinders, and we are seeing good growth across all the platforms, across all the different products that we have today. We are confident going into 2026 in terms of delivering that new guide that we gave out for 2026, but also we also gave a 3-year guidance also at the same time of 20% revenue growth from 2025 to 2028.
So really long-term perspective here, just dialing in on the profitability side, because you're right, many loving the fact that you delivered this full year profit. What now to really drive up that return on equity? Our Bloomberg Intelligence analyst talking about maybe it's the net profit to really be driven higher needs even more leaning into the fintech side of the business or some cost cuts. Where do you pull?
Yeah, there's really 3 big pillars when you look at the business today. One is continuing the growth momentum in our rides business as well as our deliveries business. And our deliveries also, now we have other products and services. For example, grocery delivery continues to be one of our fastest growing. It's actually growing 1.7 times faster than our food business today. We also have dine-in, which is another unique set of product features that brings people to the restaurants also at the same time. Financial services also continues to be our fastest growing segment of our business today. The loan book size that we have today, we've clipped over $1 billion in loan portfolio, and we expect to double that as we finish the year 2026. So we've got all the different products working together to really drive that growth in the business, but also margin expansion at the same time.
From delivery to fintech, Grab CFO Peter Oey there. Talking of fintech, Coinbase was about to report earnings after the bell, and this comes in the context of a deepening crypto rout, which has seen the value of Bitcoin in particular plunge, look, more than 45% from its peak. And with that, expectations of Coinbase's revenue are not looking pretty. Bloomberg senior crypto reporter Olga Karif joins us now. And it's all about volumes, right? And they're going to pull back, so inherently revenues must have been hit.
Absolutely. So what happens when prices drop continuously? A lot of the retail traders stay on the sidelines. And of course, crypto exchanges, they make a huge portion of their revenues from transaction fees. So they see a huge drop in that.
What I understand, Olga, I get the volumes concern, but I've always understood that like Coinbase, others that it competes with, they benefit from volatility, right? Because volatility, you have to trade in one direction or another. Why is that not a good moment for them?
So you're absolutely right. When there is high volatility, they do benefit. But typically what happens is that you have, say, several days of very high volatility, such as in in October when Bitcoin dropped a lot, or in early February when again it dropped a lot. So you can have a lot of volatility, a lot of trading during those days, but then you can have slower activity, lower activity in the days kind of in between those very high volatility days. And that can impact exchanges. Like, for instance, we've already seen Robinhood report that its fourth quarter crypto revenue was down 38%. So things are not looking good for crypto trading providers.
Briefly, Coinbase has tried to diversify ahead of this. They're looking whether or not it's predictions markets, whether or not it's equity trading, Olga. Is that enough?
So Coinbase has been trying to diversify for many years, and these are really good initiatives that could really help in the years ahead. But right now, for instance, they just launched prediction markets, so it's a very small revenue driver. They do have stablecoin revenue coming from their revenue share with Circle. That is helping to stabilize revenues quite a bit. But a lot of the other revenue portions are still small.
Bloomberg's Olga Creed, thank you very much. That does it, Caro, for this edition of Bloomberg Tech.